everyone, and welcome to this panel discussion. And first off, a huge thank you for our panelists for being available today to answer a very tricky question: are managers still interested in South Africa? And I suppose a short answer, and maybe what's going through some of our delegates' minds, is it could be no. I mean, think of the sluggish economic growth, stage 6 load shedding, which we've now experienced, all the immigration farewell parties, particularly in this Bryanston area, which I live in. It almost seems an easy answer, but there's two things that I would give for food for thought to start off the discussion is, if you look at where a lot of pension funds and savings a large part of that is in the multi-asset high equity category. And if you look at the assets, and those are just retail assets sitting in that category, it's well over 800 billion rand. If you compare that to the flexible category that can have more of an offshore exposure, or the global flexible, those categories probably have 60 to 70 billion rand each. So the multi-asset high equity category is very important, and that category has all your regulation, 28 funds, where 55% of that investment still has to be in South African stocks and bonds. So it is very important, and you can't help but be interested in it. And as I think our experienced fund managers will tell you, that there are always opportunities to be found. So that is the second important thing to give context for our discussion today. And when one thinks of South African equities, I think it's very important to note that it isn't just all about South Africa. There's various ways in which you can segment the market to look for these opportunities. And I'm going to start off with Jacobus. If you can please describe for us how a Fairtree, which has both a top-down, a macro sort of way of looking at the opportunity set, and a bottom-up, how you actually segment the listed equity market.
Thank you, Jennifer. Great topic, by the way, and I'm looking forward to our discussion. So, as an active manager, the way we think about South Africa is, first of all, the SA-listed space is not the economy. We've said that many times. 2/3 of our revenues actually are generated offshore. So we have to have a key handle on what is happening in China, in Europe, in the US, and other emerging markets. Those factors often drive returns in South Africa. If you then break up the investment landscape or the opportunity set in different sectors, then looking at resources, about a third of the market, and within resources, you've got diversified miners, you've got platinum miners, gold miners, energy, paper. So even within your resource bucket, you have very different drivers across those resources. Global auto dynamics is more important for the PGMs. What's happening in China and the evolution of the green economy is important for the diversified miners. Gold is driven by real rates, geopolitics, reserve managers, how they think about their reserves. And same with paper, that's more linked with European activity. So I think if you then look at the other global components, offshore, developed market, defensives, so these are your tobacco and alcohol companies, they do well when the economy, global economy, comes under strain. They've got this rand hedge capability, the same with the offshore consumer growth. And SA Inc. is about a third of what's left in the market. So if you marry this up, a strong bottom-up and top-down approach, you can find opportunities. We've been managing a SA equity fund for the last 10 years or so without any direct global exposure, and we've produced strong returns, strong alpha over time. It's a matter of whether you can link your skill set with the opportunity set.
Thanks so much, Jacobus. And Murray, just thinking of Laurium's, also your investment approach, you do bring in this sort of macro element. Do you look at the market in the similar way? And also, if you could maybe dig in for us, like the SA Inc. component. A large opportunity there has been in the banks side of things. Banks has run quite well, and can that opportunity continue?
Yeah, thanks, Jenny. We do look at it a similar basis. I mean, we don't look at it on revenues. We actually strip it out into earnings. So it's a very composite market that we have. if you strip out pure domestic South Africa, that excludes the resource stocks. I mean, we get a number of around 20, just under 30% is the only the SA market, which is the banks, the insurers, property, etc. And so there are a lot of opportunities in our market. I think the thing to remember is that SA hasn't been in a great space. Confidence not good. We had Zuma, we had 10 years of lost opportunity. Then we had Cyril, we had Ramaphosa that came in, we all got very excited. Then we had the riots. Then we had COVID. We had COVID first, then the riots. And then we have had load shedding. So it hasn't been pretty good. And if you look at our growth in South Africa, number I was just looking the last sort of 14 years from that, we've grown at 1.2% per annum. Not very good. We do think we could grow maybe a little bit more going forward. But that is a big driver, domestic South Africa, particularly if you look at the banks, which is a very big component of the market. They have, however, done fairly well. As you said, there's some quite decent positives. I mean, South Africa, some of the previous panelists talking about take all your money offshore. I think one must diversify. One has rand liabilities as well. And in the SA universe, there are some very attractive. There's a lot of negative news priced in at the moment. So banks, for instance, we have a big portion in banks. Banks have been performing pretty well since COVID, recovered really well. I think in the last 12 months, they've probably done about a 16% total return, some 8% ahead of the market. And you're still buying them on, the overall banks index is an 8 multiple. You're buying the ABSAs and the Nedbank groups at a 1 times price to book. You're getting them on a 6 times multiple. And your dividend yields are 8-9%. And we do think that if you look into next year, they will still manage to grow. Rates start coming down. The endowment effect won't be there. But we still think they look very attractive. As one of the previous panelists said, you do get some of the cash. I mean, 3 of the banks have actually paid dividends in the last 2 weeks. You've got 4% back from ABSA, Standard Bank, and Ned Group. Just 4% of your capital came back in the last 2 weeks, and we still think they grow. So they still look pretty good.
Yeah, so there is that opportunity within that SA Inc. component, and just and that's particularly with the banks. But maybe let's just touch quickly on the industrial side of that, just that SA Inc., the one that has got the companies that have got these South African economic drivers to it. The fund managers we have today has got a fundamental approach to their stock picking as well. And there's a lot of valuations that goes to that, company analysis, sector analysis. But one of the things we've just picked up this week on Monday is that you've had 3 of your industrial stocks, being the Fashini Group, Mr. Price, and the MultiChoice Group, that were removed from the MSCI Emerging Market Index. And what that then means is those fund managers, particularly offshore, then that track indices had to sell out of these, which has put those shares under pressure. So, and Neville, I mean, knowing Coronation's approach, it is quite that fundamental stock picking, but how does this kind of offshore manager sentiment affect where you would go to in terms of the opportunities?
Thanks, Jenny. Look, for us, it creates opportunities. So, I mean, we see that all the time. There's quite a few index rebalancings happening. The moment Anglo Gold as well, as you know, they're moving from primary listing from South Africa to offshore. It actually means that it's going to go down massively in emerging market indices. And they're only going to the international indices about 9 months later. So you have these huge flows out. And then in 9 months, potentially, you got flows coming in. So typically what you do see is it creates opportunities for fundamental investors, because these people are selling for non-fundamental reasons. It's no longer, it's off benchmark, you can't own it, you have to sell it regardless of price. But a bigger issue has just been the lack of offshore interest in South Africa as an emerging market. As Murray was saying, we're a low growth environment. Typically emerging markets are attractive to foreign investors for the growth. You take more risk. As you know, emerging markets over the last few years has been a haven of risk. We've had Russia,
yes.
You've had China, issues in SA. So people know there's risk, but they go there because there's outsized growth, big populations, potential to grow. Now, if you're an emerging market without growth, you really have got nothing to show, and that's why, 10 years ago, we had a lot of foreign investors with very big holdings in those same companies We remember, all of us looking at, Foschini and Mr. Price with 60-70% of their shareholder register was offshore. Today, that
Yes.
number's down dramatically, and that's because they can't see the growth and they're just not interested in taking on the risk that goes with it. And then within that lies the opportunities, is finding there, where the market has really given up on stocks, which we think can still actually show earnings growth. That's where the opportunities are going to lie.
Okay, so what I take from that is that even though these shares have fallen, they could still then actually present a good opportunity.
Yeah,
Yep.
any mechanistic forced selling is going to create mispricings. And I mean, our entire, you've got a panel of active managers here. We're going to tell you, this is our game, and this is what we love, is mechanistic selling, because no one cares what price they're selling at, whereas we fundamentally care about price. That is what we spend our lives doing, is trying to understand intrinsic value. And if you see people, and it's great when we can see why, because often you'll see a share price is down. Now you're trying to work out why is the information you're missing. If the information's there and it's obvious, then it gives you that great opportunity to buy it, and why the market's mispricing it.
Okay, great. Thank you. So we have so far explored that SA Inc. component, just going back a slide. And as we said, we've got these offshore drivers that then impact majority of the market. So those are those orange blocks on the right-hand side there. And, these offshore drivers can be both a positive and a negative. So for a long time, you've had the Naspers and process, which was driving a large part of our market, that was driven by Tencent. And then China wakes up and decides they want to implement increased regulation on education apps, and Tencent takes a knock, which then has an impact on Naspers and process. And now we've got the Magnificent Seven, which is sort of almost creating that concentration risk in the offshore market. And then my question to the panel is then, can we see some sort of maybe concentration risk that could also build up over the next few years in our listed market, given those offshore drivers? And maybe starting with you, Jacobus, and then followed by Murray.
Sure. So if you look at those Magnificent Seven, they're very much concentrated in consumer tech-like sectors. I think 28% or so of the S&P 500 is concentrated in those 7 stocks. If you then look at 7 or 8 stocks in South Africa, the top big ones, it's about 35%. So it's actually more concentrated to that extent. But then breaking it down into the different sectors, about I think a third is Naspers and process, banks is another 10-11%. Mining is also around about 10%, and you've got, I think, MTN, which is the 7th one. So you've got a much more diversified sector exposure, and I would argue diversified factor exposure to utilize, which actually potentially makes us a little bit more defensive if we were to go into a scenario where AI comes under pressure, or those tech stocks comes under pressure.
Okay, so less concentration than probably what we had previously with the Naspers process run. Yeah.
Yes.
Okay. Thanks, Jacobus.
Yeah, Naspers is at the moment in the Capstrix about 15. If you add process Naspers together, it's about 15%. It was up above 20%. I mean, in fact, if you go back to concentration, the All Share Index, and some people still track the Aussie, you had Billiton that was over 10%. You had Richemont at 13% a year ago. Now, Richemont rallied very strongly. It's fallen quite a bit this year, particularly in Swiss francs. So those were very big in the Aussie. The Capstrix, we think, is a better index, sort of in the weighting. But Naspers is still very big in our market and a big driver. If you look the last 5 years, it's interesting, our market's only done 6%, been pretty pedestrian relative to global. And if you look over the last 10 years, our market has only done 8%. So it's been pretty miserable being in SA, and I think that's why everyone is so not so happy in SA and want to go to the States, where it's been so big. The returns have been so good. I think that you could have a sort of a period of a year or two where that could change. But Naspers numbers the last 5 years, it has, despite the buybacks and what they're doing, restructuring, so they should have been growing faster than Tencent, has only done 8% compound per year. So it's only 2% ahead of the market because you feel it's more. But if you go back 10 years, it's been much bigger driver. Over 10 years, Naspers has given you 19% compound, so 11% better than the cap Swix. So that's why it's got bigger and bigger. So it is 15%, very important still in how things look. The good news, I mean, from our analyst, Dwayne Dippenaar, he's very bullish on things. We think he's too bullish, but notwithstanding, we do think Tencent still looks pretty solid, and there is a very big continued buybacks, which intrinsically unlock value, notwithstanding for the Naspers process. So that's the good news, and that's a decent chunk of the SA market anyway.
Okay. Thanks, Murray. Let's move on to maybe resources again and the global drivers for resources. Neville, we've got China. Again, these offshore drivers can be both positive and negative, and we do seem to be sort of moving around in terms of the resource side. Where would you be seeing opportunity on the resource side in China, or should we even be hanging our hat on that?
Look, I mean, China is a big part of the resource story, as we know. I mean, they import, a large chunk of the seaborne in specific commodities. Kobus mentioned, I mean, resources in South Africa, there are different drivers. The PGMs, as I said, is very much related to the fate of the internal combustion engine. China, I mean, the world, I mean, we tend to take a very Western view, or you see in the comments in the papers, a very Western-focused view on China. I mean, I had to laugh. You had Joe Biden the other day calling out the Chinese economy after his economy just had a banking crisis and he nearly couldn't pay the debts because he had hitting his debt ceiling. So, you've got the UK, which had its trust the lettuce kind of moment. Global economies, a lot of global economies are in quite difficult places. And in fact, China, I think they're handling it the appropriate way, which is, the world's upset that they haven't pulled out a bazooka and sprayed money, which is what the US and the UK did when they hit COVID. Now, they saw what happened the last time they did that, post the GFC. You had lots of property bubbles, you had debt getting misspent. So they're taking a much more measured approach to how they deal with the economic malaise and emerging. So it's not bazookas, but, they are definitely easing. They've been gently easing interest rates. They've been opening up property. So, we're not concerned about China broadly. We don't see a China crash, which is why we're comfortable with the resource position. The big driver for resources, as we all know, is the green transition. So that is really what's going on. The key metals for diversified players, things like copper in particular, are, there's a massive transition taking place, and the world is short of the commodities that it's going to need in order to drive that. At the same time, the world is not investing in the old commodities, which means there's a shortage. We saw that last year with the invasion of the Ukraine. Suddenly, coal prices went up ridiculous amounts because no one in their right mind's been building new coal mines. So at this point in time, you're seeing a shortage of the old cycle commodities, which is keeping your price tension there. And there's a massive shortage of the new ones because new mines are just not being made fast enough. So we still think that there's very strong underlying demand drivers. Within that, you're going to have lots of cycles. So you get to hit these little pinch points, prices go insane, and then they come back through to normal again. But broadly, we feel quite positive, other than the PGMs, where, interesting enough, I mean, people want to bash China. The Chinese adoption of EVs has blown everyone away, how rapidly that economy has transitioned to electric vehicles. And that's having a very negative impact on the outlook for the PGMs. I mean, there's a long-term story for PGMs, which is around, green hydrogen. But in the interim, you've got this period where a lot of demand that was going into palladium for petrol autocats is effectively hitting a very big air pocket and potentially going to see weak prices for quite some time.
Thanks, Neville. So across the SA listed market, we can see opportunities. It's SA Inc. It's going to be the ones with the offshore drivers, but it does come down to price and valuations, and I think that's been mentioned a few times so far. So what we are showing here is what we call the forward PE of the market, or the domestic South African blended companies. So maybe, Murray, if you can take us through what the slide is telling us, and from what we can tell here, even though it's at the bottom, that actually means that that's an opportunity still.
Okay. As you say, Jenny, what the slide is, all it is doing is taking the domestic component. So it's the banks the insurers, the property, Barlows, the retailers, and we aggregated the earnings and the market caps, and we get a PE. So if you look at that chart, you'll see that historically you've traded around a 12 times multiple, South Africa. For 1 year forward, that's how SA was priced. Right now, we're being priced more than probably 2 standard deviations cheap to history, and we are trading at sort of close to a 9.5 times multiple. The question is that the right multiple or not? It's very cheap relative to history. I think one of the big issues that is causing that is bond yields, because bond yields set the price of everything. So in South Africa, your 10-year is around 11%. We used to be down at 9%. So there's a 25% increase in basically your cost of capital. So if you look at a bank, for instance, what happens is you discount your future cash flows, you take the risk-free rate, which let's say is the SA bond of 11, and then you add an equity risk premium of, say, 4 or 5%. So you have to discount at probably 15, 16% your bank earnings. And because of that, the PE multiple that you have today has to be lower. So we do think it's at least 1 standard deviation lower is where it should actually be. It's 2 standard deviations. So we think the SA market, notwithstanding all the negative news out there and where bond yields are, we think they are slightly cheap on that basis where the bond yields are today. And we also do think that bond yields at 11%, that's a real yield of 7%. That is quite amazing. So if you compare our bonds, in particular if our SOF, which is our dollar bond, so you buy a US dollar bond, we're 3.5% risk premium above the US dollar bonds, your 10-year, and the 5 years as well. It just seems too much. So the risk premium built into South Africa, in our view, is too high, and we could quite easily narrow by 1% or so. I think if electricity, we get that. We do believe in the middle of next year, and we had a little hiccup now, but I think if we look a year forward, there's a lot of fixed investment going on into electricity. Our fixed investment spend this year is going to be close to 4% and 4% next year. We haven't seen that in years, but it's all going into solar, wind, etc. We will see the benefits of that into next year. Now, when that happens, businesses will do better, domestic will do better, and we think that's when you see bond yields lower, and with that, the domestic market could perform quite well. So that's what we think. This is probably get back to 1 standard deviation at least by mid next year.
That's a very positive outlook there, Marie. Thank you.
Very
yeah, very good. Thanks. And then Jacobus, just when thinking about the bond yields where they are quite attractive, I suppose. Yes, it does look quite high, but then actually can present an opportunity. How do you view those bond yields, just the outlook for them, and just then coming back to just the impact on the equity valuations?
Yeah, sure. So I believe, I agree with Murray that these valuations are cheap.
Yeah.
Obviously for a reason. And they could stay there unless there's a catalyst. And he's mentioned a few of those catalysts. And I believe if we look at the next, say, 12 months, I agree with Murray on the electricity front. Eskom will bring some of the old plants, the breakages back onto line. We think the energy availability factor, even at the low or mid-50s, plus the private sector's investment and the embedded generation will give us a much better outlook for next year. And the moment you get that, you get the unlock of profit margins improve for some of the retailers and a lot. But bring it back to bonds. So we think those things will be catalysts for bond yields as well.
Yes.
But also the fact that inflation is coming down. So inflation, the last print at 4.7%, close to the midpoint of the target. This week we had also inflation expectations by the BER came out lower than expected. And with the current real rate, policy real rate at 3.5%, I think we need to go back 18 years before we get to a same level of restriction in the economy. So there's scope at least 50 to 100 basis points of cuts, which we believe can start to play out next year. So at the moment, it's a bit of a timing game as to what other risks are we facing in the short term, fiscal being the other one. And therefore, when you think about a fixed income portfolio or fixed income positioning, we actually like the belly of the curve we think those rate cuts and improvement in growth could drive down yields. We think the front end of the curve does look attractive, especially on the cash front, but looking forward, we think the market isn't going to be in a hurry to price in lower yields very quickly, maybe 50 basis points and so. So we like the belly, we're kind of neutral on the front end, and we are cautious on the back end. So we still have an underweight duration position on the back end of the curve because of these fiscal issues that we're facing, and hopefully, by the 1st of November, we'll get more clarity as to what government plans to do, or the Treasury plans to do in cutting spending, hopefully not issuing any nominal debt, which we don't think will happen, and hopefully not increasing our taxes.
Thanks, Jacobus. Sorry, and then just bringing it all back to valuations and where the opportunity set is. And Devil, I think one of the things I actually mentioned to you that I found interesting is that the word quality is, comes out in the slide.
Yeah.
And in our discussions, you're saying, well, there is opportunity there, but you just can't go anywhere.
Yeah.
So maybe you want to talk us through where we should be looking for quality.
Sure. So, this is quite a busy slide. So, at Coro, we're very much a data-driven organization. So, when COVID hit us, we got all our analysts into the office, by the way. We worked all our analysts in the office through COVID. And we redid all our models for what we saw was a very tough time coming. And then what we did was we wanted to track all the companies actually. So now we've rebased all the earnings expectations. How are the companies actually faring compared to these rebased expectations? Are they coming out in line, better, or worse? And what was remarkable for those first 2 years was actually, by and large, SA companies came out better. They had slightly more resilient top line. They were more aggressive on cost cutting. And again, I think testament to the quality still of a lot of SA management teams. But what we've seen now in 23, which is the last one here, you're just seeing now a slew of results coming out worse than what analysts have expected. And you really are starting to see the of all the bad things that are happening in our economy, that's just gone past the ability of the companies to actually deal with these. So the point is, yes, there are a lot of very cheap shares in our market. Yes, people aren't interested in our market. And it's all for very good reason, which is it's an unbelievably brutal, tough environment that we're operating in. We list a couple of things up there. It's load shedding, water shedding, municipal rates growing at massive rates. You've got limited pricing power because the consumer's so weak. You've got high interest rates. All these things are hitting at the same time. So it's very important. But the market has been quite fairly brutal in selling off most shares equally. So our point is, this is not a time for you to go scratching around in the bargain basement bin. If the market's treating a lot of SA shares as just cheap, now's the time when you want to focus on quality. Because what we are finding is that even within certain sectors, or in each sector, you're finding winners and losers. And in an environment where the markets are not growing, all you're doing is that winners taking share away from someone else. When the whole market's growing, everyone can do very well. The quality guys do really well, and actually the weaker guys, funny enough, often they do better because they're coming from a more marginal background. But in a very tough environment, those winning businesses are taking share away from the weaker businesses, which means they're facing rising costs and declining top line. And it's a very obvious example which has just been playing out over the last week or two, which is a ShopRite, for example, versus the rest of the FMCG retail sector. It's an incredible business. It's harvesting investments that it made 5-10 years ago, and it's just getting stronger and stronger and more powerful, and it's absolutely killing the competitors to the point that we're not sure that they'll actually be able to see their way out of this. So this is not a time when you want to be dabbling with the kind of mean reversion. This share's been hit really bad. I think it'll bounce back. It's around making sure that, yes, there's value. Yes, it's a tough place, but you want to be in those quality businesses. And so I've spoken quite a bit, but I think the other very important point on this kind of thing of looking at the low PE is the cash flows and where those cash flows are going. So in a SA environment where every CEO is looking at his business, he can't find any growth, but he's got this machine which he invested in over the years and it's generating cash. We as shareholders want to get that cash. Him as a CEO is now starting to look at, well, do I go now and buy growth? And that, again, is another massive accident waiting to happen. We know how that story ends. 80 to 90% of the time, it doesn't work out very well for shareholders. So it's also important, not just that you're buying the quality businesses that are able to grow in a tough environment, but you're identifying those that are actually going to return that cash to shareholders. Because, short of a miraculous re-rating, which who knows when or not your return is going to come from your dividends. And you want to make sure that as shareholders you're getting those dividends back.
Thanks very much, Neville. I've got the time up sign, so I've actually prepared quite a lot more questions, but thank you very much to all of you for sharing your insights today. And I think what came up very clearly to me is that there are positives there, and just to go back to the old adage, it's darkest before dawn. I think in our case, we're not exactly sure when that dawn is coming, but we can see that both from a bottom-up perspective, there are many positives that you can look at. We do just need a few small catalysts to change, bring down those bond yields a bit, becomes a very good catalyst for our companies and valuations. And thank you so much for sharing the detailed examples as well where you see those opportunities. So our asset managers are interested in South Africa. Thank you very much, everyone.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.